Hello and welcome to the webinar. I am Andrea O'Neill, co-manager of SCO's Investment Banking Program. Today we take a more detailed look at key financial concepts and types of analyses used regularly by investment banking professionals. By the end of this webinar, you should be able to identify key methods of valuation and financial metrics that bankers use to evaluate and advise their clients. You should be able to sound more informed about financial concepts and lay a good foundation to prepare for upcoming investment banking interviews. First, we will dissect the three core financial statements which are used by investment bankers to understand more about their clients' financial health, business operations, and capital structure. The quarterly or annual performance summarized on the income statement, balance sheet, and statement of cash flows serves as a cornerstone for financial valuation, which we will discuss later in the presentation. Let's now take a closer look at each one of the financial statements. The income statement is a window into the operating performance and efficiency of a firm's core businesses. It is a constantly updated record of key metrics related to profitability like revenue, cost of goods sold, and other operating expenses. Bankers use historical data points from the income statement to forecast future performance and make assumptions regarding a company's long-term financial outlook. Meaningful changes to major line items from one period to the next can help bankers identify red flags and help advise their clients on strategies to improve operational and financial efficiency. Take a few moments to look at some of the major key line items that appear on the income statement. Next, let's look at the balance sheet. The balance sheet summarizes a firm's assets, liabilities, and shareholder equity. Categorized as either short-term or also known as current and long-term, these itemized assets and liabilities provide bankers with a snapshot of how well a firm balances their capital structure, what the firm owns versus what the firm owes. Bankers analyze the balance sheet to determine if a firm has the right leverage, liquidity, and solvency to operate in a sustainable way. Items on the balance sheet are also taken into account when determining the full worth of a company. Take a few moments now to review the assets, liabilities, and shareholder equity section of the balance sheet. The statement of cash flows separates the firm's cash into operating, financing, and investing activities. Operating activities include the production, sales, and delivery of the company's product, as well as collecting payment from its customers. This could include purchasing raw materials, building inventory, advertising, and shipping the products. Investing activities include activities where cash in and outflows are not associated with the core business operations of a company. Examples of these types of cash flows could be related to M&A activity, purchase or sale of an asset like land, a new building, or marketable securities. Financing activities include the inflow of cash from investors such as banks and shareholders, including the issuances of new equity or debt products to raise capital, as well as outflows of cash in the form of dividends or servicing for long-term debt obligations. Take a few minutes now to look at some of the line items within the operating, investing, and financing activities of a company. Some key concepts and ratios used frequently by investment bankers are derived from items found on the three financial statements. For instance, on the income statement, a calculation to determine earnings before interest, taxes, depreciation, and amortization, or EBITDA for short, can be used as a proxy for free cash flow, which is the basis for DCF analysis. Cost of goods sold is a key line item on the income statement in calculating profit and its related ratios. Leverage ratios, like debt to equity, use important information from the balance sheet to quantify a firm's risk of default and the cost of financing. Becoming familiar with the three financial statements, their uses, and the related financial ratios will help you create a broader picture of a firm's current and future performance. Now let's move on to exploring two major methods of valuation, DCF and the comparable company analysis. Valuation tools and analyses is the core bread and butter activity of investment bankers. Valuation is both an art and a science. It relies on historical financial information and concrete numbers, as well as reasonable, rational assumptions provided by the bankers in order to determine the value of a company. While there are industry standards around the methods and mechanics of valuation, different bankers' preferences and proprietary firm practices may result in varying valuation outcomes for the same company. First, let's speak about the comparable company analysis. often referred to in banking jargon as comps. It is a relative valuation technique used to determine the value of a company by analyzing similar competitor companies within the same sector. This valuation method is based on the idea that companies with similar characteristics should have similar valuation multiples. The standard procedure for spreading comps, as it's called, is to determine a peer group of publicly traded companies, gather the financial data for these companies, decide on key statistics relevant to the industry like earnings per share, equity value to EBITDA, price to earnings or PE, and benchmark the companies and determine a reasonable valuation range of the client company that you're working on. Comps are oftentimes displayed in pitch books to show clients how they are valued relative to their peers and positions against the industry at large. As you get ready for investment banking interviews, you can try an exercise where you select a peer group of your favorite publicly traded company and assess some of its financial metrics relative to the peer group in the industry. This will give you a foundation for understanding more about how investment bankers will look at the company and analyze companies you will potentially hear about in financial news. Discounted cash flow, or DCF for short, is a valuation technique that is based on the idea that a company's free cash flows can best help determine total value of the firm. Free cash flow represents the cash that a company is able to generate after laying out the money required to maintain or expand its asset base. Free cash flow is important because it allows a company to pursue opportunities that enhance shareholder value. Without cash, it's tough to develop new products, make acquisitions, pay dividends, and reduce debt. For this reason, some investors believe that free cash flow gives a much clearer view of the ability to generate cash and therefore profits. The DCF method uses the company's own historical financial performance to forecast future cash flows out to a terminal value where the growth of the cash flows is constant. These future cash flows are then discounted back to the present value using the company's weighted average cost of capital, also known as WACC. Investment bankers use WACC because it takes into account a company's cost of equity and cost of debt. Finally, these cash flows are summed to determine a net present value, or the acronym NPV. Don't worry if a lot of these terms and concepts seem foreign to you right now. The point is to understand the difference in types of valuation. The mechanics will come as you get into your upper level finance courses and through the course of your investment banking internship. As you prepare for your investment banking careers, here are a few other terms and concepts that every well-positioned aspiring banker should know. Please take a few moments to review them now. And finally, the best prepared Wall Street professionals start their journey of learning very early. If your goal is to work on Wall Street, we suggest laying a foundation by engaging yourself in market news, finance, accounting, and economic concepts every day. The more you practice, the more proficient and competitive you become. Best of luck from the SEO team.